All right, everybody, welcome back. This is part 2 of chapter 6. So let's get going with the actual accounting inventory flow assumptions. First one we're going to deal with is first in, first out. In a real world basis, you'd probably see actual inventory moving in and out of a company on a first in, first out basis when it's something that spoils quickly, right? Like a grocery store. In particular, I like to think of dairy products, right? As a grocer, if it was our business, we want to sell the first things we got first, right? First in is the first stuff we want to sell, because if you've got something that we buy, let's say on Monday of this week, right? And we get some more dairy on Tuesday, you want to sell the stuff from Monday as soon as possible, because the oldest stuff is going to go bad, right? Now remember, using a cost flow assumption really doesn't matter if your company actually follows a plan like that, as long as you stay consistent and you follow any one of these inventory flow assumptions. They are all accepted by generally accepted accounting principles. They just require that you maintain consistency. You don't go changing it just to benefit your numbers and make your company look like it's doing better. But let's go ahead and jump into it. That's the assumption we're going to use. And again, remember that key word is assumption. It doesn't matter if it's based in reality or not. So again, we're going to use the exact same numbers. Nothing is going to change for us except the assumption of what we sold and what it cost. So remember, our beginning inventory balance is we've got 10 bikes that cost us $91 starting at the beginning of the month, August 1st. We're going to go out and make those same exact purchases. August 3rd, we're going to buy 15 more bikes, add those to inventory. This is what we've got right before we make our first sale. So now we're going to sell the exact same amount. We're going to sell 20 bicycles, but our company uses the first in, first out inventory costing method, right? So we're going to assume that the 20 bikes we just sold, first, we're going to assume that the oldest bikes were sold first. So can we get all 20 bikes from the oldest inventory that was in our inventory account? No, we can't. We can only get 10 of them. Then we have to move to the next most oldest inventory. My apologies for the piss poor English I'm using here, but that's what we're doing. So we're going to get 10 from the beginning balance because we only have 10. If we had 20 that were sitting in beginning inventory, we'd get all 20 from there, but we don't. We only had 10 plus the 15 that we purchased next. So we'll start with the oldest and slowly work our way forward. Got 10 from the beginning inventory and 10 from the next sale. So what are we left with? Well, we used all 10 of these. We used 10 of these, so we're left with 5 bicycles from the August 3rd purchase. Now again, is it based in reality? Is that exactly what we sold when we sold these 20 bikes? Do we know for sure that we sold these specific 10 and 10 from here? We do not. This is not specific identification, and this company doesn't track their inventory. And frankly, tracking inventory is pretty expensive and not really what a company is in business of doing, right? They're in business of buying and selling bikes, not tracking what each bicycle costs them. That can be expensive and costly. All we're doing is assuming. That's why it's called an assumption. We're just saying, hey, we're going to follow this assumption method and always assume that the first bikes we purchased are the first ones we sold. And remember, it really doesn't matter because these are identical products. So don't worry about whether this is actual or whether it's really what's happening. Just remember, we are following an assumption. So after this sale, we've got 5 bikes that cost us $106. 5 left from this August 3rd purchase. Real important, by the way, when you're doing your homework and to understand this stuff, after every transaction, whether it's a purchase, write out what's left in inventory. Write out the number of units, what each of those units cost, and the total if you were to multiply them out and add them up. And after every sale, right, we're going to get the cost of goods sold, but also write out what's left in inventory. My advice, use these slides. These are the same examples that are in the book, in the chapter, but use these slides and you're going to want to make your own charts that kind of follow this format. It'll make your life easier, trust me. So August 17 comes along, we purchase 20 more bikes. This is what's in inventory after we purchase it. The 5 from before and now 20 more that cost us this. Same thing, August 28th, we're going to purchase 10 more bikes at $119. This is now what's in inventory, right? Both on a per unit and a per unit cost basis and a total cost of all the inventory. So we've got ourselves 35 bikes with different costs now. So when August 31st comes along, we sell 23 of them. Where are those 23 coming from? We don't really know, we don't really care, but we're going to assume, just so that we can come up with a valid cost of goods sold, we're going to use that same first in, first out method, and we're going to try and get the oldest, assume that the oldest inventory was sold in those 23. So we'd get the oldest, there's only 5 of those. So we're going to still be left with 18 bikes that we're going to assume came from the next oldest group, which is out of here. So we'll take 18 out of this group and we're done there. 5 from the absolute oldest and 18 from the next oldest. Make sense? So we just take those amounts, plug them in, and we can come up with our cost of goods sold for this sale that happened on August 31st. Once again, after every transaction, be it a purchase or be it a sale, you want to write out what your ending or remaining inventory is. Here, of course, we sold these 5 bikes and we sold 18 of these, so all 10 remain of these and 2 remain of these. This is what it would look like, folks. Write it out, multiply it out, and get your total. So we want to know the units of inventory left. We want to know what the per unit cost is of each of those groups, and we want to know the total. Write it out. Trust me, when you're doing your homework, it will make your life easier, and it'll make this stuff far more digestible and understandable. And this is the stuff you're going to be doing on the quiz and the exam, so trust me when I tell you this. Helpful hints. That's first in, first out. This would be the cost of goods sold for the first one and your remaining inventory after the first sale. Cost of goods sold for the second sale and the remaining inventory after the second sale. This is what your homework is going to be asking you, so I point these out to you. Now again, remember, all the transactions that we looked at for this company are the exact same. Doesn't matter. Just in the first example, we specifically tracked what the inventory was that we sold. And in the second example, we used the first in, first out assumption. So everything stays the same except the cost of goods sold, because we assume that we sold different bikes with a different cost. Same thing for that second sale. And that's what's really unique and interesting, I think, about this whole chapter is just based on what assumption you use, your actual financial statements will change, and they can change significantly just based on which assumption you use. And of course, it's a good time to mention those ethics we spoke about in chapter 1. There are rules, there are ethics, of course, involved in accounting, and we always want to use the conservative method. There is a tendency for managers like CEOs of big companies to want to always present the lowest expenses and the highest possible income. Well, this is one way that you can actually manipulate those numbers, right? By choosing which assumption you'd want to use. So, of course, ethics comes in. It's a key concept here. Always take the high road. That's what I say in both accounting and in life, guys. Talk a little bit more about that in just a bit. Let's move on to the second assumption. Last in, first out, LIFO. Almost the exact opposite, right? The oldest costs remain in your ending inventory, and we assume that the most recent purchases are what we just sold. So almost the exact opposite. So again, starting with the exact same beginning balance, 10 bicycles that cost us $91. We go out and purchase 15 bicycles. This is what's in our inventory right before we make our sale. No difference for any of those examples. Now let's move into the sale. August 14th, we sell 20 bikes and we're using the last in, first out method. So the last in, first out, we're going to assume the most recent inventory that we purchased. The last ones that went into our inventory count. Well, the last ones that went in were these 15, right? So we're going to presume that of the 20, we're going to use up all 15 of these. If there was 20 there, we just assumed that all 20 came out of the most recent purchase. But there isn't. So we can get 15 from the most recent, from the last ones into inventory. Then we got to go to older ones that were in inventory before that, right? So 15 would come from the most recent group, 106, and would have to get the 5 from the $91. Multiply those out, add those amounts up, and that gives you your cost of goods sold. Once again, do we know that those were the exact bikes that of the 20 we sold, 15 really came from the August 3rd purchase and 5 came from beginning balance? No, remember, it's just an assumption that we follow. We don't have to worry about where it really came from. Once again, we want to, after every purchase, we write out what's in inventory, both on a unit, per unit, and a total cost basis. Same thing after every sale, right? We were assuming that we sold all 15 of these, and we're assuming that we sold 5 of these, so 5 of these $91 bikes remain. So this is what's in our ending inventory balance after that sale, August 14th. Same exact numbers come in here, nothing different about the August 17th purchase. This is what's in our inventory afterwards, right? We buy 20 bikes at $115. We're just going to add those to our already what we had in inventory, the 5 bikes at $91. August 28th, we're going to make another purchase. This is what remains in our inventory. Going to make that sale once again, August 31st. We're selling the same 23 bikes, but we're using the last in, first out method. So last in, the last bicycles that were put into our inventory account would be these, right? We can get 10 of the 23. That leaves us 13. So we go to the next group, right? The most recent group that we put into inventory, and we can get all 13 from that group. So that's what our calculation would look like for the cost of goods sold for that August 31st sale. This is what our ending inventory would be right here. Once again, just looking back at our August 14th sale, this would be our cost of goods sold, right? And this would be our ending inventory. This is what your homework's going to be asking you for. So make sure you write out these charts really well. It'll make your life easier, and it'll make it a lot more understandable. And of course, same thing for August 31st. This is our cost of goods sold, and this is our ending inventory. And these are the numbers that we'll plug right into our journal entries. This cost of goods sold from August 31st and cost of goods sold from August 14th, which I'll show you here. August 14th cost of goods sold and reduction to merchandise inventory, and August 31st, which comes straight there. Everything else, of course, remains the same. Which brings us to our last one, which is weighted average method, okay? And this is once again an assumption. All we do is whenever we make a sale, we take the average cost of all the units that are in inventory, and we assume that all the bicycles or all the units that we sold all have the exact same cost, which is the weighted average of everything that is in inventory just before we make the sale. So again, same exact example, same exact numbers. We've got beginning balance inventory, 10 bikes, cost us $91. August 3rd, we go out and purchase 15 more. Now, real important, what I want to do here is you see the 10 bikes that cost us $91, but you also see the 15 bicycles. What we want to do now is take the weighted average. And the way we do that is, well, we've got 25 bikes and a total cost of $2,500. So if we were to divide that, we'd get that each bike has a weighted average of $100 per unit. And that's what we assume when we make our next sale. So we assume we're selling 20 bikes. We'd use the weighted average of those bikes for a cost. We assume that all 20 had a weighted average cost of $100 per unit. Very easy to calculate out. Just remember to calculate the weighted average after every transaction, or at a minimum before every sale that we do. So we're doing it right before we make the sale. We get the average, which is $100 per unit. Also, be sure to write out what's left in inventory. We don't know any more of individual costs. We just take the weighted average, right? We had 25 with a weighted average of $100 per bike. We sold 20 of those 25, so we're left with 5 at $100 weighted average, which is $500. We're going to go ahead and make a couple purchases. Look at those. Remember to write out what the ending inventory is after each purchase, right? But on top of that, for the weighted average method, we want to know what the weighted average is for each bike. So we've got 25 bikes with a total cost of $2,800. Divide 2,800 by the total number of units, 25 bikes, and you get an average per unit, $112. When we go make another purchase of 10 bikes at $119, you could multiply all those out again, get the total, divide by the number of units, and get your weighted average. And this is right before we make our sale. That's the amount we'll use for our sale. So August 31st, when we sell 23 bikes, we assume that they were all at the weighted average. And that's the cost that we input to our journal entry for cost of goods sold. And this, of course, would be our ending inventory, right? If we had 35 bikes before, each at a weighted average of $114. When we make our sale of 23 of them, well, we'll be left with 12, and we presume that those that are left in the inventory account have the exact same weighted average. Makes recording it a lot easier than the other methods, at least after the sales, right? And this would be the total amount if you multiplied it out. So weighted average in a nutshell, once again, we know what the cost of goods sold is for our sale and what our inventory is afterwards from the August 14th sale, and the same thing for the August 31st sale that we make here. Once again, the only thing that changes for our journal entries for this example is the cost of goods sold and the merchandise inventory that goes down for both of our sales transactions. Now, what's really interesting, if we take a look here and compare, basically we looked at the identical transactions for this company called Trekking Company. And just based on whatever method of accounting they used, right, or which inventory flow assumptions they used, whether they specifically track their inventory or whether they use one of the three methods that we went over, you can see that their net income that they report could be significantly different. And what we're using here is, very simple small numbers to make these examples a little easier to understand. But if you can imagine these being in the millions rather than in the thousands, you could have very significant difference just based on which method you used, even though they did the exact same thing, identical transactions, both sales and purchases, yet using one method over the other makes a difference of quite a bit. There's advantages to each, which I'll let you read through the chapter, and they're summarized here on this slide, and that is it for Chapter 6. You guys are doing great. I hope you're enjoying yourselves. Feel free to leave me some messages on the discussion boards or send me a message individually with any feedback. Enjoy.